Republicans in Congress want to change the way the government collects taxes from corporations. They want to dramatically reduce the current federal corporate tax rate, which taxes a company's profits, from 35% to 20% or less. To make up for the subsequent loss of revenue, a controversial Republican plan would introduce another measure known as a border adjustment. It would impose a U.S. corporate tax on imports and remove taxes from exports, generating over a decade about $1 trillion. To show how the border adjustment works, let's use the example of a U.S. automaker. Say the car it sells is assembled in Tennessee. Some of the parts of the vehicle are made in the U.S., but many of the components are produced all over the world, some in Japan, some in Mexico. Let's say the total cost of buying those foreign parts comes to $10,000, and the finished car is sold at the dealership for $20,000. Under the current system, the automaker deducts the $10,000 and the cost of its domestic labor, let's say $6,000, from the $20,000 and only pays corporate tax on its total profit of, let's say, $4,000. At the current rate of 35%, the tax bill for the car maker is $1,400. Under the border adjustment system, the car maker still gets to deduct its $6,000 in labor costs, but it doesn't get to deduct the cost of its imports, which means it would be paying taxes on $14,000 instead of $4,000. That would be a far bigger total tax bill than under the current corporate tax policy. That's why big retailers, oil refineries, car makers, and other import-reliant businesses are lining up against the proposal. They say a border adjustment would force them to raise prices to turn a profit, hurting not just them, but also the wallets of most Americans. But many public finance economists say a border adjustment might not cost companies and consumers more because it would cause the value of the dollar to rise, making imported goods cheaper than they are now, thus counteracting, in terms of profit margins, the higher tax bill. Among the goals of such a proposal, encouraging domestic investment. Companies like the car maker in our example would, in theory, buy more American-made goods. The border adjustment would also discourage companies from moving their addresses, intellectual property, or jobs outside the U.S. But if adopted, it might violate the rules of the World Trade Organization, raising an entirely new set of possible implications.